Your money-making broadcast starts now. Good evening, Canada. Today is June 1st, Monday. Here are the top stories moving the markets. We are witnessing a historic surge as the S&P 500, NASDAQ, and Dow Jones all hit new all-time highs simultaneously. While the U.S. markets soar on AI optimism and positive manufacturing data, Canadian investors are weighing the impact of rising oil prices and a shifting interest rate environment on the TSX. Before we dive into the big stories, let's look at the closing numbers. It was a banner day for the bulls. The S&P 500 closed at 7,599.96, up 0.26%, hitting a new record. The NASDAQ followed suit, closing at 27,086.81, up 0.42%. The Dow Jones also reached a new peak at 51,078.88, rising 0.09%. However, it wasn't a rising tide for all boats. The Russell 2000 was the odd man out, slipping 0.47% to 2,905.76, signaling a continuing rotation toward quality and large-cap AI leaders. In the volatility space, the VIX rose 4.77% to 16.05, which is still stable but suggests a hint of caution among traders. The U.S. 10-year Treasury yield fell slightly to 4.455%, keeping the environment friendly for risk-on assets. In commodities, Brent crude rose 0.34% to $95.30, while gold ticked up 0.19% to $4,514.80. For Canadian investors specifically, this commodities backdrop is critical. Rising oil prices provide a natural hedge for the TSX heavy energy weighting, while a stable yield environment supports our dividend-paying sectors. The TSX composite is particularly sensitive to this energy commodities complex, and today's setup suggests a favorable session for Canadian heavyweights. Big Story 1, the AI infrastructure supercycle and the HPE explosion. Today, we saw a massive validation of the AI trade that extends far beyond just chipmakers. Hewlett-Packard Enterprise, or HPE, skyrocketed by 30% after reporting its biggest earnings beat since 2018. This is a critical signal for Canadian investors because it proves that the demand for AI servers and networking infrastructure is not just a bubble, but a tangible revenue driver. JAVIS analysis highlights that the market is moving into a quality rotation phase. While the headline indices are hitting records, the real money is flowing into companies that can actually monetize AI. We saw this with Salesforce, or CRM, which surged over 10% today to hit $210.93. For Canadian investors watching the TSX, this AI infrastructure wave has direct implications that go beyond just U.S. tech stocks. Canadian Pacific Kansas City, CP.TO, trading at $122.67, stands to benefit from increased rail volumes tied to data center construction materials and semiconductor supply chains moving across North America. The company's unique transcontinental network connecting Canada, the United States, and Mexico positions it as a critical logistics partner for the AI supply chain. Similarly, Enbridge, ENB, Canada's premier energy infrastructure company, provides a stable dividend yield of roughly 6% that acts as a portfolio ballast during the volatility that AI-driven market rotations create. For Canadian income-focused investors, ENB's regulated pipeline revenue model offers predictable cash flows regardless of AI market sentiment swings. JAVIS identifies a strong correlation between the positive ISM manufacturing PMI, which came in above 50, and the surge in enterprise software demand, suggesting that industrial and tech-adjacent sectors in Canada may see a sympathetic lift as the global economy proves its resilience. However, JAVIS has shifted to a highly defensive posture, moving cash levels to a staggering 93.1% of the portfolio. This suggests that while the trend is bullish, the risk-to-reward ratio at these all-time highs is becoming skewed, requiring a strategic retreat to preserve capital. Big Story 2, the Alphabet capital surge and the Berkshire seal of approval. One of the most significant institutional moves today was Alphabet's plan to raise $80 billion through stock sales to fund further AI build-outs. This massive capital injection is paired with a stunning move by Warren Buffett's Berkshire Hathaway, which invested an additional $10 billion into Alphabet. When the Oracle of Omaha doubles down on a tech giant while the company is aggressively funding its own infrastructure, it sends a powerful signal to the global market. This is not just about search engines anymore, it is about the foundational layer of the next industrial revolution. For the Canadian Observer, this confirms that the AI cycle has a long runway, and Canadian pension funds like CPP Investments and Ontario Teachers are likely to follow suit with increased AI infrastructure allocations. We are seeing a transition from the chip phase, where NVIDIA dominated, to the infrastructure and application phase. This is why we saw Broadcom, rise nearly 3% today on the back of new broadband AI chips. For Canadian portfolios, this transition opens opportunities in adjacent sectors. Shopify, Canada's e-commerce giant trading around $80, stands to benefit as AI-powered advertising and merchant tools drive higher conversion rates and platform adoption. Shopify's recent investments in AI-powered fulfillment and merchant analytics make it a direct beneficiary of the enterprise AI wave. Meanwhile, Royal Bank of Canada, RY, Canada's largest bank by market capitalization at over $170 billion, provides exposure to the capital deployment side of the AI story. Canadian banks are among the most active financiers of data center construction and AI infrastructure projects across North America, making RY a unique Canadian angle on the AI infrastructure theme. JAVIS notes that while the momentum is strong, the volatility is creeping up, with the VIX rising 4.77% to 16.05. This divergence, record highs paired with rising fear indices, is a classic warning sign that a period of consolidation may be approaching, which explains why JAVIS exited positions in SoFi and CRM today to lock in gains. Big Story 3, Macro Headwinds and the Energy Nexus. Turning to the macro picture, the Bank of Canada and the U.S. Federal Reserve remain the focal points of market attention. The U.S. 10-year Treasury yield dipped slightly to 4.455%, which is generally a green light for risk assets. However, the energy sector is providing a complex backdrop that directly impacts the Canadian economy. Brent crude has climbed to $95.30 per barrel, fueled by uncertainty surrounding ceasefire talks in Iran and ongoing OPEC+ production discipline that has kept global supply constrained. For Canada, this is a double-edged sword. Higher oil prices typically bolster the TSX and the Canadian dollar, providing a tailwind for our energy giants like Suncor Energy and Canadian Natural Resources. But as Donald Trump continues to express indifference toward the outcome of Iran talks, geopolitical volatility remains a primary risk that Canadian energy investors must price into their positions. The Canadian dollar, or the loonie, is currently trading in a range that reflects both the tailwind from oil revenues and the headwind from a strong U.S. economy that keeps the Federal Reserve hawkish relative to the Bank of Canada. The Bank of Canada's next policy decision is particularly important. If the BOC signals a more dovish path than the Fed, the loonie could weaken further, which would be a net positive for TSX-listed exporters but a headwind for Canadian consumers facing imported inflation. For Canadian investors holding U.S.-denominated assets, this currency dynamic adds an extra layer of strategy to portfolio construction, favoring USD-hedged positions in the near term. JAVIS observes that the Russell 2000 was the only major index in the red today, falling 0.47%. This indicates a stark divide between the AI elite and the broader small-cap economy, a divergence that is even more pronounced on the TSX where a handful of large-cap names dominate index performance. For Canadian investors, the lesson here is clear: focus on quality, liquidity, and dividend stability. The current bull market is on its 39th day, approaching the historical average of 42 to 49 days. With the S&P 500 at 7,600, the margin for error is slim. We must watch the upcoming JOLTS and non-farm payroll data this week, as any sign of economic overheating could trigger a hawkish response from central banks, potentially reversing these record gains. Additionally, the Bank of Canada's next rate decision looms large. Any dovish surprise would provide a significant boost to Canadian real estate and consumer discretionary stocks on the TSX. To wrap up today's action, we have a market at record highs, but a portfolio that has shifted almost entirely to cash to protect gains. The divergence between the AI leaders and the small-cap struggle suggests a narrow path to victory in the current environment. Canadian investors face a unique set of circumstances. Rising oil prices support our energy-heavy index, but the global rotation toward AI-quality stocks demands selective positioning. Based on JAVIS's technical and fundamental analysis, here are 4 strategic picks for different investor profiles, with particular emphasis on Canadian opportunities. For the safe-type investor, the legendary value investor Ben Graham would choose Canadian Pacific Kansas City, CP.TO, at $122.67. This pick is based on the company's low volatility and its role as a critical infrastructure backbone in North America, providing a necessary safety margin during market turbulence. CP.TO benefits from the reshoring trend and Canada's position as a resource and logistics hub, making it a defensive core holding for any Canadian portfolio. With a beta below 1.0 and consistent dividend growth, CP.TO offers the stability that safety-oriented investors require in a market where the VIX is signaling caution. For the balance-type investor, the legendary fund manager Peter Lynch would choose Broadcom, AVGO, at $459.97. This choice balances high-growth AI networking demand with a proven track record of diversified semiconductor revenue, offering both growth and stability. Canadian investors should note that Broadcom's revenue streams are diversified globally, reducing single-country risk while capturing the AI tailwind. The company's recent VMware acquisition is beginning to bear fruit, providing an additional software revenue stream that diversifies its hardware-heavy business model. For the growth-type investor, the world's leading innovation fund manager Cathy would choose Palantir, PLTR, at $161.25. The rationale here is the explosive momentum in AI software integration and government contracts, which fits the profile of a high-conviction innovation play. Palantir's expanding partnership with Canadian defense and logistics firms adds a unique cross-border dimension to this pick, and its AIP platform is seeing accelerating adoption among enterprise clients seeking practical AI deployment solutions. For the low-cost type investor, the global investing master John Templeton would choose Carnival Corporation, CCL, at $27.62. This is a contrarian play, betting on the continued recovery of global travel and the eventual mean reversion of cruise line valuations as debt levels stabilize. For Canadian investors, the weakening loonie actually benefits CCL since its revenue is largely USD denominated while operational costs include Canadian port fees and labor sourced partly from Canada. Looking ahead to the rest of the week, all eyes are on the employment data. We have the JOLTS report on Tuesday, ADP payrolls on Wednesday, and the big one, the non-farm payrolls, on Friday. These reports will tell us if the economy is cooling enough for the central banks to maintain a dovish stance, or if inflation fears are about to return. For the TSX, the energy sector's performance in this environment will be particularly telling. If crude can hold above $95, our energy heavyweights should provide a floor for the index even if US tech faces profit-taking. Until then, maintaining a healthy cash position is the smartest move in a record-breaking but fragile market. Thank you for tuning into the Canadian Market Pulse. Subscribe for daily Canadian market insights. We break down the data so you don't have to. Check our shorts for a 60-second highlight. That's all for today. We all become wealthy together.